Yeah. Okay, so I am also presenting from South Africa. I am based in Cape Town at the University of Cape Town. And the paper title is Evaluating Adoption Readiness Towards the ISSB Sustainability Disclosure Standards, and it is a South African case study. Okay, so just a bit of background behind the study. So in recent years, the demand for sustainability reporting has really taken off. More and more organizations are weaving sustainability into their business strategies and everyday operations. This shift has been largely driven by ESG investing, where investors are not just looking at financial performance of firms, but also at how companies impact the environment and society. So, because of this, sustainability reporting has become a standard practice, especially for larger companies. But it does kind of pose a challenge. There is a challenge involved here because there are a number of frameworks and standards like the GRI, SASB, and TCFD. And because of these number of frameworks, it does make it a bit difficult to compare disclosures across companies or countries. So this inconsistency due to the numerous standards makes it difficult for investors and stakeholders to really use the information effectively. So to tackle this challenge, the IFRS Foundation set up the International Sustainability Standards Board, which is the ISSB, and that was in 2022. And the goal for the ISSB was to create a global baseline of sustainability disclosure standards that improves consistency and comparability. So in June 2023, the ISSB released its first two standards, which is IFRS 1 and IFRS 2. IFRS 1 looks at the general requirements for disclosure of sustainability related financial information, and IFRS 2 looks at climate related disclosures. So both standards took effect from 1 Jan 2024. And while each country will decide whether adoption is mandatory, the short time frame makes it clear that companies need to start preparing now. So what is the purpose of the study? So because of the number of frameworks and standards that I've mentioned now in the previous slide, the need for a global sustainability reporting standard has been widely recognized. But implementing such a standard obviously presents practical challenges. So the ISSB's building blocks approach helps countries align the existing practices with the IFRS sustainability disclosure standards, but still, it is obviously a new standard overall. So companies need to update systems, processes, and workflows in order to comply with the new standard. From a South African perspective, we can learn from past experiences. So, for example, when South Africa adopted IFRS for SMEs in 2009, the complexity was really underestimated, costs were high, and there was a limited understanding of what the change entailed. Even now, challenges remain. So, essentially, companies must interpret the standards, define what to disclose, and then collect and evaluate relevant data, all of which, of course, take significant resources. And what stretches capacity even further are the tight reporting timelines where sustainability disclosures need to accompany financial reports. So all the costs aren't just financial. We need staff training, or companies need staff training and system upgrades, and that is essential part of implementation as well. So essentially, this research paper looks at how prepared South African companies are for the IFRS sustainability disclosure standards. It explores current practices and what companies are doing in order to get ready for the new standard. So in South Africa, while adoption isn't yet mandatory in South Africa and in many places, understanding readiness is critical for smooth transition, especially if regulators like the Johannesburg Stock Exchange or the Companies Act eventually require adoption. So this research is grounded in organizational change theory, and that focuses on the concept of organizational readiness for change. There are two key aspects which are important when it comes to this theory, and that is change commitment and change efficacy. Change commitment looks at, do people value the change enough to support it, and change efficacy looks at whether they believe they have the ability, resources, and capacity to implement it. So this highlights the importance of financial, material, and human resources in determining whether companies are truly ready to adopt these standards. Okay, so onto the methodologies. So this is a qualitative research paper, and we decided to use a single case design. So basically, this means we focused on just one company to really explore its readiness to adopt the new IFRS sustainability disclosure standards. So the goal here was to get a deep understanding rather than a broad overview. And that's essentially why we looked at just one case study. The company we chose is one of South Africa's top sustainability reporters, according to the Johannesburg Stock Exchange. So they've built a strong reputation for integrating sustainability into the everyday business operation, rather than just treating it as a compliance exercise, which a lot of companies do. And that made them a great candidate for this kind of study. By looking at how this leading company aligns with the IFRS sustainability disclosure standards, we can get a sense of what best practice might look like in the South African context. It also gives us a benchmark to compare other companies against, especially those that might not be as advanced in their sustainability journey. So even though this was just one company, the findings are likely to reveal challenges that many other companies could face too. So in other words, what we learn here can help us understand the broader readiness of South African companies as they all prepare to adopt this new standard. So data was collected through content analysis of annual integrated and sustainability reports, which was complemented by a semi-structured interview with a sustainability manager responsible for reporting from this top JSE sustainability reporting company. Publicly available reports were assessed against the IFRS framework to evaluate alignment and identify potential gaps. So insights from the sample company which is considered a sustainability leader in South Africa, also offered guidance on sector-wide challenges. So we looked at essentially still on the methodology. There were two research questions which guided the study. So we firstly looked at how well the company aligns with the four core elements of IFRS S1, which is governance, strategy, risk management, and metrics and targets. Essentially, these form the backbone of the new sustainability disclosure standards. And to measure this, we calculated the company's percentage compliance for both 2022 and 2023. We did that by dividing the number of requirements by the company met by the total number of requirements that applied to them. And this gave us a clear picture of how the reporting improved or didn't over time. Now, it's worth noting that the conceptual foundations and general features were only introduced in the final IFRS S1 standard issued in June 2023. So those sections were only assessed against the company's 2023 reporting. So from there, we identified where the company still had gaps in meeting the standards. We also developed recommendations to help them and other companies work towards full compliance in future reporting cycles. Finally, our assessment was guided by the organizational readiness for change theory, which I have mentioned before. And this helped us evaluate not just the technical compliance, but also the company's contextual factors, commitment, capability, and overall alignment with the conceptual foundations of the IFRS standard. So moving on to the findings and looking at the core elements. So the four core elements that I mentioned are listed there. And the first core element under IFRS 1 is governance. Essentially, that looks at how companies manage sustainability risks and opportunities. So our sample company achieved full alignment in both 2022 and 2023, showing a very strong governance framework, which was amazing. Oversight is shared across the board, Sustainability Committee and Social and Ethics Committee, while clear reporting lines and accountability. So the company's readiness is largely thanks to King 4, which already promotes responsible corporate citizenship. The Companies Act also requires a Social and Ethics Committee aligning well with IFRS 1. But unlike many peers, this company successfully links governance directly to sustainability risks, showing us that King 4 adopters are very well positioned for compliance with the new standard. Under the strategy element, we saw steady improvement. The alignment rose from 45% to 54%, as can be seen. And the company now in 2023 discusses short, medium, and long-term sustainability horizons and risk management across its global value chain. However, they haven't yet disclosed the financial impacts of sustainability risk, which remains a key gap. One reason for the financial gap is the difference in focus. So IFRS 1 is very investor-orientated, while most South African frameworks take a broader stakeholder approach. And this mismatch obviously adds complexity, so companies will need to balance investor expectations with wider sustainability reporting. Then onto risk management. So the alignment started strong and reached 100% by 2023. Disclosures covered risk parameters, impacts, and monitoring, meeting IFRS expectations. For other South African firms, the challenge is resourcing. So sustainability often gets absorbed into general risk frameworks, so maintaining transparency is critical. Then lastly, under the metrics and targets, the company fully met IFRS S1 requirements in both years. They disclosed detailed metrics and progress towards targets like net zero carbon emissions, supported by clear milestone. So this level of transparency aligns well with IFRS objectives and global best practice. Okay, then still looking at just the overview. So the IFRS sustainability disclosure standards set the foundation for sustainability reporting, focusing on two key principles, which are relevance and faithful representation. Our sample company's approach aligns well with IFRS S1. It has a sustainability committee overseeing disclosures who determines what is material through stakeholder engagement, risk assessments, and global benchmarks. This transparency helps build credibility and stakeholder trust. So although IFRS S1 encourages the use of additional frameworks like ISSB and CDSB, the company hasn't used them, which reflects a broader trend. Only around 17% of JSE top 100 companies has adopted ISSB by 2021. IFRS S1 also requires sustainability information to be included in general purpose financial reports, such as integrated or management reports. The company follows this practice, which aligns with South African norms. However, integrating sustainability reporting with financial statements can be demanding. Tight deadlines and limited resources often make it challenging for companies to publish both sets of financial information simultaneously. Okay, so looking at competing frameworks and implementation, I'm not sure if you want me to skip the slide because it does look like I'm going to go over time. So I'm happy to skip the slide if need be. Chair, you can just advise.
Sorry, you have just 1 minute left. Just one.
Okay, so I'm going to skip this slide. I'm going to move on to the findings because I'm rather going to want to present this. So the findings, looking at the insights from the sustainability manager. So in the interview with the sustainability manager, several challenges came up around adopting the new standards. Timing, firstly, is a major concern. So the standards officially apply from 1 Jan 2024, but local adoption depends on regulators like the JSE. Internationally, momentum is growing. Countries like Brazil, Turkey, and Australia are already consulting or committed. Still, research shows that companies rarely adopt voluntary standards unless required. So the manager stressed that full compliance right away would be tough. IFRS S1 is complex and detailed, and every company will have gaps to fill. So in order to comply, firms need to upskill staff, review current disclosures, and align internal systems, which can be costly and time-consuming. Having prior TCFD experience helps, but companies without it may struggle more. Internal metrics may conflict with IFRS, and dual reporting might be needed in order to meet stakeholder expectations. While the ISSB's building blocks approach is designed for local compatibility, it focuses on investors, so companies may need to adapt for broader engagement there. And then the challenges go beyond reporting. There are system and process changes which are required across the businesses. What I mean there is that firms must decide whether to train staff, hire specialists, or outsource works. From an organizational perspective, IFRS adoption is a big change. Readiness really depends on commitment and capability, like I said. So commitment would arise from actually seeing the benefits, like better investor access, and capability actually involves having the resources, systems, and leadership to implement. Then lastly, looking at the conclusion of the study. So our case study and interview reveal that governance practices are well aligned with King IV principles, which supports compliance with global reporting standards. Strategy and metrics remains a challenge, particularly when internal measurements or multi-stakeholder frameworks don't match IFRS requirements. Risk management disclosures are generally strong. Companies already following TCFD or JSE guidance are in a better position, definitely, for this transition. Although the JSE's double materiality approach is different from IFRS S1, which focuses primarily on investors. Our findings also support key theoretical perspectives. So institutional and governance theories suggest that robust governance structures make compliance with global standards easier. And then I did mention the organizational readiness theory, and that highlights that firms need both the desire to implement change and the ability to do so. From a managerial perspective, firms need to integrate sustainability into governance, strategy, and risk management processes. It's critical to link sustainability risks to financial outcomes and to incorporate scenario analysis as well. Then operational readiness is also key, and this includes staff training, system upgrades, and coordination across functions. CFOs and audit committees play an essential role here in ensuring the quality of disclosures. And then lastly, policy-wise, from a policy perspective, regulators can play a critical role by providing clear adoption timelines, guidance, and incentives for early compliance. Harmonizing IFRS is one with local reporting frameworks will make adoption a lot smoother. And then finally, capacity building initiatives will help firms enhance transparency, build investor confidence, and gain better access to global markets. Sorry, I did go a bit over time there, but I am done.